Welcome to Corporate Finance Explained, where we break down the essential topics every corporate finance professional needs to know. This series is narrated by AI, created using CFI's expert training materials, and designed to help you stay ahead in the world of finance. Enjoy this week's deep dive.
Okay, so I want you to imagine a battlefield. It's complete chaos. You have thousands of soldiers, let's call them companies, fighting tooth and nail for every inch of territory. Most of them are just getting slaughtered.
Yeah, margins are getting crushed. It's brutal.
It is brutal. But then, right in the middle of all this chaos, there are a few fortresses.
Ones that seem to be playing a completely different game.
Exactly. They aren't just surviving. They're like completely ignoring the war outside. They're printing money decade after decade. And when you look at the data, it's this central mystery of the corporate world.
Right.
Why do some companies shoot up like a rocket, capture the zeitgeist, and then boom, 3 years later, they're bankrupt? While others, the titans, they just seem to defy gravity.
It's a great question. And, the answer usually isn't luck. It's not magic. It is structural.
Structural. That is the key word. So today, we are doing a deep dive into competitive moats. And before anyone rolls their eyes thinking this is just more corporate buzzword bingo, let me stop you. We are working from a really dense, fascinating guide here on corporate finance and competitive strategy.
Yeah.
We're not talking about like brand vibes. We're talking about the physics of profit.
Right. The mission today is to move past the cable news version of this. You hear pundits say, oh, that stock has a wide moat, but we need to explain the mechanics.
Yeah, what does that actually mean?
How does a company actually build a wall around its cash flow? And maybe more importantly for anyone listening who invests or helps run a business, how can you tell if that wall is about to crumble?
Because if you get that wrong, you're buying a first-class ticket on the Titanic.
Right.
So let's start with the basics. The term moat. I know Warren Buffett made it famous, but what are we actually defining here?
So Buffett's metaphor is just perfect because it's so visceral.
Yeah.
Picture a medieval castle. The castle is the business, the gold inside. That's your profit. Now, outside the castle, you have the enemy. That's the competition. And the moat is that physical barrier, the water, the alligators, whatever, that stops the enemy from swimming across and stealing your gold.
And in capitalism, the enemy is always swimming.
Always. This is the fundamental law of economics that people often forget. Profits attract competition. It is just. It's inevitable. If you open a coffee shop and you're charging $10 a latte and making a fortune, I guarantee you within a month, I'm opening a shop next door charging $9.
And then someone else opens one for $8. And pretty soon we're all charging $4 and, barely keeping the lights on.
Exactly. In a perfectly competitive market, that process just continues until nobody's making any super normal profit. Margins get ground down. That's the natural state of things.
Right.
A moat is a disruption of that natural law. It's a structural anomaly that lets a company keep charging $10, keep making those high margins, and stop me from stealing their customers.
So finance teams aren't just looking for good products. They're looking for unfair fights.
Precisely. And this is why the CFO cares so much. It's not abstract. A moat shows up directly on the spreadsheet. If you have a moat, you have pricing power.
Meaning you can raise prices without losing all your customers.
Yeah. Protects your margins. It drives your ROIC, your return on invested capital.
Okay, I want to put a pin in ROIC because I know we're going to get nerdy with the math later. I want to really get that.
Yeah.
But conceptually, having a moat just means your dollar today is worth more because it's safer for longer.
It's all about durability. Valuation, what a company is worth, it's just the present value of all its future cash flows.
Right.
If you don't have a moat, I can't predict your cash flows 5 years from now because a competitor might just eat your lunch. But if you do have a moat, I can model those cash flows out for 20 years. That makes the company worth significantly more today.
Okay, so we know what it is. It's armor for your profits.
Yeah.
Let's talk about what it looks like. You can't just go to the store and, buy a moat. The source material outlines a blueprint, a few specific types of these structural advantages. And I want to walk through the big ones because some of them are really sneaky.
They are, and not all moats are created equal.
The first one on the list is switching costs. To me, this just sounds like the customer hostage strategy.
That's a cynical way to put it, but it's pretty accurate. Yeah. Switching costs are all about friction. It's when the benefit of switching to a competitor is just outweighed by the pain or the cost or the time it would take to actually do it.
It's like my bank.
Yeah.
Absolutely hate my bank. The app is glitchy. The fees are annoying. But the thought of moving my direct deposit and resetting my auto pay for the electric bill, the mortgage, all the streaming services, it just makes me want to lie down. So I say.
And that inertia is money in their pocket. You're basically paying a laziness tax. But here's where it gets really powerful in the B2B world. Business to business. Imagine a company running some huge enterprise software, like an ERP system, that manages their whole supply chain.
All right, so they spent millions training their staff on it.
Yeah.
It's integrated into every warehouse, every shipping container.
Exactly. Even if a competitor comes along with a product that's, say, 20% cheaper and 10% better, the company won't switch.
Just too much hassle.
The risk of downtime, the cost of retraining thousands of employees, the sheer headache of technical integration, it's just too high. And that gives the incumbent huge pricing power. They can raise fees 5% every year, and the customer just pays it because the alternative is chaos.
So if you're looking for a moat, look for a product that's deeply embedded in how a customer does their job. If ripping it out feels like major surgery, that's a moat.
Correct. Surgery is expensive and risky. People avoid it.
Okay, next up, network effects. This is the one every Silicon Valley pitch deck claims to have, but very few actually do.
It's the holy grail, really. The definition is simple. A product or service becomes more valuable to an existing user as new users join the network.
The classic example is the telephone, right? One telephone is a paperweight. Two is a walkie-talkie. A billion is a global communication utility.
Right. But think about why that creates such a powerful defensive wall. It creates a winner-take-all dynamic. If you wanted to launch a competitor to, say, a dominant social network today, it doesn't matter if your app has better filters or a cleaner interface.
Because my friends aren't there.
Exactly. You have the cold start problem. Nobody joins because nobody is there. And nobody's there because nobody joins. The incumbent has a defensive wall made of people. It just becomes self-reinforcing.
The sources note that this creates a kind of flywheel. But are there limits?
There are, sure. You can hit network saturation, but generally in that growth phase, this is probably the most potent moat in existence because it scales exponentially, not linearly.
Speaking of scaling, that's the third big category, scale advantages. Now, is this just being big? Because I feel like big companies die all the time. Sears was big.
It's not just about revenue size. It's about relative scale compared to your competition and how that impacts your cost structure. It basically means I can produce my widget cheaper than you can because I'm making 1 million of them and you're only making 1,000.
So you're spreading your fixed costs, like the factory, over way more units.
Exactly. If we both build a factory that costs, say, $10 million, but I produce 10 times the volume, my cost per unit for that factory is 1/10 of yours. I can lower my prices to a level where you bleed cash, and I'm still profitable. I can starve you out of the market.
The sources also mention things like brand strength and regulatory barriers like patents or government licenses.
And those are real, but they're often less durable. Brands can fade. Look at fashion. Patents expire. The big three, switching costs, network effects, and scale. Those are usually the structural pillars that support the longest-lasting dynasties.
But here's the catch, and the source material is really emphatic about this. You can't just identify the moat and go to sleep. Finance professionals are obsessed with one question.
How long?
Yeah, how long?
The width of the moat and the depth of the moat. Because nothing in business is static. A moat is either getting wider or the enemy is filling it with sandbags to cross over.
So let's look at some castles that are holding up. The guide gives us a couple of gold standard case studies. First one, Visa.
Visa is incredible. It's a masterclass in network effects.
They call it a two-sided network, which I think is a great distinction.
Right, so you have two distinct groups, merchants, the stores, and consumers. Why does a bodega in New York accept Visa?
Because everyone has a Visa card.
And why do I carry a Visa card?
Because every bodega accepts it. It's that chicken and egg problem that they solved 50 years ago.
And once that loop is closed, it is nearly impossible to break. But the financial beauty of Visa, and the source really highlights this, is the operating leverage.
Okay, explain that for the non-CFOs listening. Operating leverage is one of those terms that sounds dry, but is actually where all the magic happens.
Okay, so think about the rails of the payment network. Visa spent decades and billions of dollars building the infrastructure, the data centers, the security, the partnerships. That's the fixed cost.
All the upfront work.
Right. But now, if you buy a coffee for $5, the cost to Visa to process that digital signal is It's virtually zero.
It's pure margin.
It's incremental revenue with almost zero incremental cost. So as the volume of global transactions goes up, Visa's profits just explode. They don't need to build more factories. They just process more bits. And that leads to incredibly high ROIC and massive, massive cash flow.
Which explains why their stock chart looks like a staircase to heaven.
Okay, let's talk about the other heavyweight, Apple. People always say Apple is a brand moat. I buy it because it's cool.
Right.
But the analysis says that's not the real story.
The brand gets you in the door. The ecosystem locks the door behind you. This is a classic switching cost moat.
The walled garden. It's a very comfortable prison. Think about it. You have the iPhone. Then you buy the AirPods, which pair magically. Then you get the Apple Watch, which tracks your health. Then you buy movies on Apple TV. Your photos are in iCloud.
If I switch to Android tomorrow, I'm not just changing my phone. I'm basically breaking my digital life.
You'd lose your iMessage history, the dreaded green bubbles versus blue bubbles. You'd lose your photo sync. The friction is just massive. And because the friction is so high, Apple has pricing power. They can charge $1,000 for a phone that costs $400 to make.
And we pay it.
We pay it gladly. And that creates what the source calls high customer lifetime value, or CLV. They don't have to reacquire you as a customer every 2 years. They know you're buying the iPhone 16, the 17, and the 18. That predictability is why they're one of the most valuable companies on earth.
And this is the scary part of the deep dive, even the biggest castles can fall. We have a section here on moat erosion. An example they use is just brutal. Blockbuster Video.
Oh, the cautionary tale to end all cautionary tales.
And it's so important to remember, Blockbuster wasn't some fragile startup. They were a juggernaut. They had a massive scale moat.
They did. They had 9,000 stores. They had a distribution network that no local video store could touch. They could buy DVDs from the studios for pennies on the dollar because of their volume. They were absolutely crushing the competition.
So what happened? We all say Netflix, but structurally, what broke the moat?
The terrain changed. Blockbuster's moat was physical proximity. I'm 5 minutes from your house. That was their whole advantage.
Right.
When the internet allowed Netflix to stream video or even just mail DVDs, proximity became totally relevant.
But here is the specific insight from the source that blew my mind. It wasn't just that they lost their advantage. It's that their advantage became a liability.
This is the scale trap. Blockbuster had huge fixed costs, leases, employees, electricity for 9,000 stores. When revenue started to dip even a little bit because of streaming, those costs didn't go down. They stayed high.
So the cash burn started instantly.
Exactly. Netflix had no stores. Their costs were variable. Blockbuster was anchored by the very thing that used to be their moat. They couldn't pivot because they were weighed down by all their real estate.
That's terrifying. It means your greatest strength can become your fatal weakness if the paradigm shifts.
That's why you have to watch for paradigm shifts more than you watch for direct competitors.
There's another example in here, BlackBerry. I actually missed the clicky keyboard, I won't lie.
Yeah.
I felt very important typing on that thing.
Crackberry. Yeah, they own the corporate world.
And their moat was switching costs, right? The IT departments love the security.
Right. It was an enterprise moat. The customer wasn't the employee.
Yeah.
It was the CIO, the chief information officer. And the switching costs were high because the company's server was all hooked into BlackBerry's system.
So how did that just erode? Because companies usually hate switching tech.
The bring your own device revolution. Employees started getting iPhones and Androids for their personal lives, and they realized, wait, this is a pocket computer, and my BlackBerry is just a pager with a keyboard.
They started pressuring their IT departments to let them use their own phones for work.
So the customer shifted from the CIO to the end user.
And the end user didn't care about server security protocols. They cared about apps. They cared about a full web browser. BlackBerry's moat was built on a set of criteria security and keyboards that suddenly just stopped mattering.
The switching costs just evaporated.
Overnight. And once the moat is gone, the margins collapse.
So if I'm listening to this and I'm looking at a company, maybe I'm investing or maybe I'm thinking about working there, how do I measure this? Do I need a crystal ball?
Oh, you need a spreadsheet. The source material really emphasizes a quantitative approach. You don't guess about moats. You look for the footprints in the numbers.
What are the key indicators?
The number one metric is ROIC, return on invested capital.
Okay, we pinned this earlier. Explain this like I'm 5. Or, maybe like I'm a smart 12-year-old with a lemonade stand. Think of a company as a machine. You put $1 into the top, that's the capital. The machine spins, does its business, and spits out profit at the bottom. ROIC just measures how efficient that machine is.
Okay.
If I put in $1 and get back, say, $1.05, that's a 5% return. That's mediocre.
That's basically a savings account.
Right. But if I put in $1 and get back $1.30, that's a 30% return. That is a super machine. Now, usually, if you have a machine that good, I'm going to build one right next to you and steal your customers, and your return will drop.
Competition jams up the machine.
Exactly. So if you see a company that has had an ROIC of, say, 20% or 30% for 10 years straight, that tells you there is a moat protecting the machine. Something is stopping the competition from ruining the yield.
That's a great visualization. What else should I look for?
Pricing power during downturns. This is the stress test. When the economy tanks, do they have to discount their product to sell it? Or can they hold their prices or even raise them? Luxury brands often have this. Essential Software has this. If you can raise prices when inflation is high and nobody leaves, you have a moat.
And presumably market share stability.
Yes, but be careful there. Blockbuster had a high market share right up until the end. You want to look at churn. Are customers leaving? If churn is low, the moat is intact.
Now, let's connect this to valuation. Why does a moat make a stock worth more? You mentioned terminal growth earlier, which sounds like a medical condition, but I assume is a financial term.
It does sound ominous, but it's probably the most important number in finance. This is where the math gets fun. When analysts value a company, they usually build a detailed model for the next 5 or 10 years. But a huge chunk of a company's value comes from all the years after that, the terminal value.
The forever bucket.
Right. If a company has no moat, you have to assume that eventually competition will crush them. So you can't bet on them making big money in year 15 or 20. You discount that future heavily. But if they have a wide moat, like a Coca-Cola or a Microsoft, you can assume they will be compounding cash for decades.
So you're willing to pay a higher multiple today for that certainty tomorrow.
Exactly. A moat lowers the risk profile of the future. It turns a gamble into an investment.
I love that phrasing. Lowering the risk profile of the future. That's actually a great way to think about strategy in general. Because this isn't just for investors, is it? This is for operators, for people running the business.
Absolutely. If you are a CEO or a product manager, this guide is your playbook. You shouldn't just be asking, how do I sell more this quarter? You should be asking, where am I digging my moat?
So, capital allocation. Where are you putting the money?
Yes. If you have extra cash, do you spend it on a Super Bowl ad? Maybe. But maybe you spend it on R&D to create a patent that's an intellectual property moat. Or maybe you lower your prices today to get more users on your platform. That's building a network effect moat.
You're sacrificing short-term profit to build long-term defense.
That is the definition of good strategy. And sometimes it means knowing when to quit.
The Fold'em strategy.
The source mentions this explicitly. Exit segments that are becoming commodities. If you realize your product has lost its moat, if you're just selling a commodity and competing only on price get out, sell that division. Reallocate that capital to where you have a real structural advantage.
It's a total shift in mindset. You stop looking at the profit and loss statement as just a scoreboard, and you start looking at it as a feedback loop on your strategy.
The expert in the source puts it beautifully. Don't just ask, what are we earning? Ask, why are we earning it?
Why? That is the deep dive right there.
Is it because we're just lucky and the market is hot? Or is it because we have a structural barrier that competitors can't cross? One is a wind that will die down. The other is a fortress.
That's the takeaway right there, the difference between renting success and owning it.
Exactly.
Before we wrap up, I want to leave the listener with a little homework. We talked about switching costs and how companies make it painful for you to leave. I want you to do an audit.
A personal moat audit. I like it.
Exactly. Look at the businesses you pay every single month. Your subscriptions, your software, your bank, your phone carrier. And ask yourself a hard question.
Okay.
Are you loyal to them because they delight you, because they are undeniably the best? Or are you just staying because the idea of leaving is too much of a headache?
Yeah.
Are you a fan or are you a prisoner?
That is a very provocative question. And I think if we're all honest, we're prisoners in a few castles.
I know I am. I'm never leaving my bank. It's too much work. They've got me.
And that's why they keep their dividend.
Thanks for diving deep with us today on competitive moats. It really changes the way you look at the world, doesn't it?
It really does.
We'll catch you on the next one.
Thanks for listening to Corporate Finance Explained. If you found this episode valuable, be sure to check out more episodes and explore CFI's highly rated courses at corporatefinanceinstitute.com. Don't forget to subscribe for more deep dives into essential finance topics. See you next time.